Hello everyone and welcome to this video. Today we're going to be going over a tabular statement question. So it's from the exam papers year 2021. So tabular statements is one of a few questions where we can get some 60 marker questions and some 100 marker questions. So the question we're going to do is a 60 marker, very similar to the 100 markers, except there'll be a few more adjustments. So having a look at the table, there's a few things we need to, keep an eye out for. We're going to have two separate tables, one taking into account the assets and one looking at the liabilities. Within the assets, we also need to account for depreciation for fixed assets, and in most high-level questions, they will be a provision for bad debt that will be shown like this. So that will have a negative effect on our assets. And what I generally do is when we see bank as a liability due to an overdraft, I still include it as an asset, but as a negative asset. So just putting brackets around it. The reason for that is when we'll be receiving money into the bank, we'll just be adding it to asset. Whereas if we leave it as a liability, we actually tend to confuse ourselves a bit more. So with that, I'll just show you the layout of the table. So you can see here now, this is the 1st of the 1st, 2020, which is the year we're doing. We have our land and buildings of 390,000, and we've incorporated the depreciation for both, so 15,000 and 47,800. So 15,000 here, 47,800 for the equipment. So essentially, everything is put in here now. I put them as underlines for those that are negative. So my two depreciations, my provision for bad debt, and my bank. As well as that, my liabilities, they're generally a bit more straightforward. They just come as the rows here. Be careful of your authorized and issued ordinary shares. So authorized just means how many we can sell. So we can sell up to 600,000 worth of ordinary shares, whereas the actual amount we issued or we have, used up is 450,000. So just be careful of that when you're inputting that figure. So we'll just do the first adjustment. So in January, we, Bergen Limited, decided to revalue the land and buildings on the 1st of 1st, 2020 at 450,000. The land element of the new value is 120,000. The reason they tell you the land element is that there is no depreciation on land. So we'll have to remember that as we go through the question. So to answer that question, what we're going to do is we are going to have to increase our land and buildings by 60,000. So land and buildings is going to increase 60,000. And whenever we revalue anything or fixed assets, we always have to empty out the depreciation. So 15,000 has to be a positive amount. And then that means that net depreciation of land and buildings will be 0. So as well as that, we're going to have to create a revaluation reserve entry. So I've done that now. We have revaluation reserve, and everything that so we're going to have to put our depreciation and the increase in land and buildings into a revaluation reserve. So that's 75,000. So the total liability change in January was 75,000, and the total for assets was 75,000 as well. So this will actually help you with your revaluation questions that can come up as 60 markers as well. So that's something to remember. So we can now say that this is corrected. We do have to be careful of the depreciation charge that will probably come up in December. So in February, we bought an adjoining business on the 1st of 2nd, 2020, which includes buildings, 75,000, equipment, 38,000, debtors, 10,000. So they're all our asset entries. Then we have liabilities, so creditors, 12,000, purchase. So the purchase was discharged by granting the seller 100,000 shares at a premium of 20 cents per share. So if we give them 100,000 shares at €1 each, what that's going to be is we're going to have liabilities 100,000, and then if we're giving them a share premium at 20 cents per share, well, we have 20 cents at 100 is 20,000. So those are all the figures that we are going to have to use. So building 78,000, equipment 38 and debtors 10. So they are all our assets. Then we have 12,000 creditors. So in creditors, 12,000. We had share capital of 100,000. And we have share premium 20,000. So that is now basically perfect. If we count up both sides, so we have 116, so that's 126,000. Whereas here we have 136,000. Sorry, I added up that wrong for some reason. I don't know how. So always use your calculator. It's 132,000. So 126,000, 132,000. So that's not balancing. We need the assets and the liabilities to balance. So what are we missing? Essentially, what we're missing, and this is always the case for these type of adjustments, is goodwill. So what is goodwill? It's basically a price you pay above the actual value of the business. And a lot of the goodwill elements, so why would we pay over the actual fair value of the business, is because it could be something like a brand name. So let's say you're buying over, I don't know, something like Coca-Cola with a huge brand name. So you'd have to pay above and beyond the actual value of its assets to get to purchase it. You could have a great customer base, so they could be like constantly expanding, and you know that whatever they're earning this year, they're going to be earning even more next year. So you would have to kind of incorporate that, and that would be the intangible asset of goodwill. Intangible meaning that you can't touch it. So what is the difference? It's 6,000. So we are going to have to put 6,000 into goodwill as a way of making this 132,000 on both sides. Okay. And essentially, that is all we need to do there. And just like in most accounting questions, no matter whenever that adjustment comes up, that's what you're going to have to do. The extra there'll always be more in the liabilities than in the assets, and you always put that addition into goodwill. So it's the price you pay above the actual value of the company based on, let's say, something like brand name, intangible asset. Very good. So next question for March. So we can tick off February. Management decides that the provision for bad debt should be increased to 4.5% of debtors on the end of March. So debtors is already changed anyway. So our debtors is now, we'll say question 3. So our debtors is 114,000. And we said that we wanted to increase it to 4.5%. So multiply by 4.5%. So if you put that on your calculator, we get 5130. So this is a negative asset. And remember, whenever we're going through tabular statement questions, it's always the increase or decrease that goes into our table. So in this case, we want to get the increase or decrease for the provision of bad debt. So if you put in 5130 minus 4160, we see there's an increase of 970. Sorry, it's in the wrong place. It's for March. So there's an increase of 970. Because it's a negative asset, the increase is going to have a negative effect on my assets. So that's why I have to put it in as brackets. So you get less 970. And what will that affect? So we know that we have to have liabilities of 970 as well. But where is that going? Well, it's going to go into the profit and loss. The reason it goes into the profit and loss is because if you're doing your question ones or your sole trader or your company accounts, any provision for bad debt, increase or decrease, has to go into the P&L. So 970. So it's always the increase or decrease, not the actual provision that goes in there. So that's perfect. That's not the hardest question in the world in comparison to the other ones. So now in May, we received the bank statement at the end of May 2020 showing a direct debit of €750 to cover insurance for the year ended and a credit transfer, which means we received money, of 3,650, which is rent receivable in advance for the period the 1st to the 5th this year to the 28th of the 2nd next year. So we might just look at what's an asset and what's a liability there. So what we've done is so there's two parts. This part here, you can't really see that well. We have this part here, okay, a credit transfer. So if we received money, that's obviously going to be revenue in our P&L, but because it's paid in advance, that means it's a gain prepaid, then it's actually going to be a liability. Because someone's basically paying us for a service that they haven't even availed of yet, so we technically owe them money. Until all of that time period has happened, from the 1st of May up until the 2nd of February, the end of the 2nd of 2021, then we still owe them that money until that time has passed. Now, if we look at, let's say, the opposite, this one here, the second part, so insurance. So in terms of insurance, so we showed a direct debit, so we paid it, of 7,500 to cover insurance for the year ended the 28th of the 2nd, 2021. So this is a payment or an expense prepaid. So they're both prepaid. So an expense prepaid is actually an asset, because if you think about it, it's the exact opposite. Well, it's the same thing that's happening, but it's in reverse for the gains prepaid. If we gave someone money of a service we haven't availed of yet, well, they'll have to give me back the money if I don't use it up, for example. Now, in this case, it's insurance, so we do have to pay in advance, but it's actually seen as an asset because we now don't have to worry about paying this again until the very end of February next year. So that's an expense prepaid, whereas the other was a gain prepaid. So We already have an expense prepaid, okay, in our balance sheet and in our statement, our tabular statement. So what we're going to do is we only need to use the figures that are given to us in the month we received the bank statement. So in May, we're only worried about 7,500 and 6,350. So in our expenses prepaid, it's going to be an asset worth 750,000. And it's going to be positive because the insurance company, if you want to think about it, owes us the money. Okay, so we gave it to them to hold until we've used it up. So until the very end of the very end of February 2021. Now, we're going to have to create, because there's no gains prepaid, so we're going to have to create a gains prepaid figure down here. So as opposed to calling it a gains prepaid, I'm just going to call it rent receivable prepaid. So there we go, rent receivable prepaid. And all we're really worried about is the figure in the question. So 6,350. 6,350. Sorry, it's a positive figure because it is a liability. Now, the difference between these two will have to go into our bank account. So if we paid out, so part 4, I'll just rub this bit out. If we paid 7,500 and we got or received 6,350, we actually lost money, or our net in our bank account is 1,150. So we lost money of 1,150, okay? So we overspent, let's say, that month. So in that case, we would have 6,350 in here and 6,350 in here, and these now both balance. So the next step for this, so this is what I think is the hardest of the tabular statements. So what we're going to do now is, because everything's being prepaid, we're going to have to look into the future to December, which is why I've created this part here. And we're going to have to see, well, what is actually going to be left in the balance sheet at the end of the year. So essentially, we're going to have to do a lot of writing to get this right. So this is still part 4, but we're going to be doing part II. So let's say we're looking at expenses. So we have 7,500. So of that 7,500, we have, it covers the full year from the first, it's a full year up until the 28th of the 2nd. So that means 12 months up to 28/02/21. So that means that you have 2 months here that are prepaid at the very end of December. Okay. So what we're essentially saying is, going into next year, or sorry, the amount associated with this 7,500. So we're going to be focusing mainly on that 7,500. And then also, so it's marked there, 7,500, but then also this amount. So this expense prepaid of 1,200 is going to be used up in 2020. Okay, so let's say we'd use it up between January and February. So let's say 600 is going here and 600 is going here. You know, to be emptying that out. So you wouldn't show it like that. But let's say that's the way it's going. So if that's 12 months, but we really only want 10 months because we're only interested in this year, we'd have to get, just like if we were doing depreciation, only 10 months is going to be used. So that's 7,500 divided by 12 multiplied by 10 is 6,250. Okay. As well as that, this 1,200 is going to be used up within the year as well. So essentially, we're only going to have 1,250 euro in our total going into next year. Okay. So we're going to have used up 1,200 and 6,250. So basically everything that's going to be used up then during the year is 6,250 plus 1,250, plus 1,200, which is 7,450. So we're going to put 7,450 in here. And then once you add that plus this minus this, it will give me my 1,250. So quite confusing, but if we just look through it again. So of that 7,500, we only want, what we're keeping for next year is 1,250, okay? 2 months. Yeah. This 1,200 has to be used up this year, because if it's an expense prepaid, then it's going to have to be paid this year. Because even if you look at it in the question, it says less creditors, amounts falling due within 1 year. It would be the equivalent for current assets. We know that a current asset only lasts a year, generally, we say. So the expenses prepaid is only up to a year. So that's how we get our 1,250 in here. And that means that what has to go in here is the 7,450, which is 1,200 plus 6,250. So I'll now erase this, but that's the hardest part of these tabular statements. And whenever a question like that comes up, just do exactly that. And it'll work out. Now, the other thing you have to do is you have to look back at the gain, or the rent receivable. So this one's going to be a bit easier. We received 6,350. How many months was it for? Well, it was for the 1st, the 5th, up to the 28th of the 2nd. So you have all of May, June, July, August, September, October, November, December, which is 8 months for 2020. And then January and February, 2 months for 2021. So that's a total of 10 months. So essentially that 6,350, only 2 months are left for next year. So in the total, we'll have 6,350 divided by 10, multiplied by 2, and we get 1,270. So if we take away that from 6,350, it means that that is the amount that we are essentially, that is being used up for 2020. Yeah. So the rest of that money, so the difference between 5080 and 7450 will go into the profit and loss account. So that means that 2,370 going down. Why is it going down? The reason it's going down is that essentially if we have our P&L account here, with having expenses, well, the expenses for the whole year are 7,450, whereas your gains was going to be 5080. So this is like an extract from your P&L, you could say. So overall, what's going to happen is in your P&L balance, so the very end of your P&L, it's going to be reduced by 2,370. So that's a little bit easier than the expenses prepaid. But I think if you first find what's in the total, so what are we carrying over for next year? So it was 2 months in both cases. So 2 months of the 7,500 was 1,250. And 2 months of 6350 was 1270. So if you do it like that, it would really be a lot easier then to find your depreciate or your December charge. So that is that there. Again, that's the trickiest thing I find with the tabular statements. So we have negative 7450 and negative 7450. So we're coming to the end now. So you can tick that. In August, goods previously sold for 1,107 by Bergen were returned. So we'll mark that. This figure includes VAT at 2.3 and markup of 20. Bergen issued a credit note for 1,000 due to delay in returning these goods. So for August, we have goods previously sold for 1,107 by us, and they were returned. The figure includes VAT, so VAT of 23%, and a markup on cost of 20%. Bergen Limited, who are us, issued a credit note, so that's like a voucher. It essentially gave them their money back for €1,000 due to a delay in returning these goods. Okay, so other ways that we mightn't give them as much money in a credit note could be a restocking charge, but in this time it's late. But they're the same thing. Yeah, we take away some money because it's either a restocking charge or because they returned late. So this is one that I believe is best done with a kind of an equation. So what I like to say here, and if I go to the next page, is that selling price, so the price that we sell it at, is equal to purchased price, so PP. So what do you do? Well, whatever you have for purchase price, you do your markup first, and then you add your VAT. So you have multiplied by 1.2%, 1.2, so that's 120%, and then 1.23. Okay, so this is your markup, and this here is your VAT. So our selling price is 1,107. We don't know our purchase price, and we use purchase price because we need to fill in for stock, because we always value our stock at the so we always give the value of our stock as the lowest of our net realizable value, so how much we could actually sell it for, or its cost. So in this case, it's going to be cost, so a purchase price or a cost price. So if you have these two brackets like this, it means purchase price multiplied by a markup multiplied by 1.23, which is our VAT rate. So we would then multiply 1.2 by 1.23, and that's going to give us 1.476. So now we can get our purchase price is equal to 1,107 divided by 1.476. Our purchase price is €750. So that means that our stock, so if they're returning the goods, that means that we can basically resell them to someone else, but the value of them, the value within the stock element is always cost. So my stock is going to be 750. So now we need VAT. So if we charge someone VAT and they return the goods, we no longer basically have to pay VAT on them, because if they're returning them, then we null and void the VAT essentially. So what do I mean by that? Well, if our stock is 750, now we have to get our markup before we get our VAT. So the markup is going to be, so essentially €900 is the amount of money we were going to sell them for if there was no VAT. So we essentially made, our markup is €150. And then the rest then is VAT. So 900 multiplied by 1.23, or you could do 900 minus 1107 would give you €207. So, or the amount we had to pay in VAT was 4,000. But now if we're getting a return, well, why would I pay for VAT? So we pay for VAT if someone buys something off us. So if someone's buying something off us, we add the VAT and then we give the VAT to the government. So if they're returning it, then whatever money I gave to the government or that I was holding for the government, I now no longer have to give them. So either they'll give it back to us, which isn't really the case, or what we were holding to give them, we now no longer have to hold it. So we take it away from our VAT. What else are we missing? Our debtors. So if we had sales return of 1,107, but we only gave them a credit note for 1,000, well, then our debtors are only going to go down 1,000. Okay, so let's say they might owe us 2,500, but out of all those goods they returned 1,107, we only give them 1,000 back, so they still owe us 1,500, even though they returned goods of €1,107. So what's the last step? So stock is 750. So 250, so less 250. So then this has to be less 250. Where is the markup going to be, or what's the difference going to be? In general, if we don't know where it goes into P&L. And I'll just show kind of a quick extract to show you exactly how you know or why it affects the profit and loss account like that. So we have our P&L extract. So what's happening? Our closing stock is going up. So that would be cost of goods sold. Cost of goods sold. So closing stock will increase my P&L. Then or sales returns, which is also in cost of goods sold, is going to reduce the value of my P&L by So then in your expenses, well, funny enough, it's going to be whatever VAT is, so it being an expense, is going to decrease. So it's going to decrease whatever our VAT figure is. Let's say if it was 1,000, well, it was, let's say, for example, say it was 4,000. Now it's only 3,793. So that's going to go down 207. And if you add all them together, you end up getting 43. So that's how it affects the P&L account. So that's how we show it. Now, so that's that one. Again, another tricky one. That's almost as tricky. Let's say the math isn't as tricky once you use that formula, but realizing where everything goes is a bit tricky. So looking at November, a creditor who is owed 2,700 by Bergen Limited accepted a fridge freezer, the net book value of which was 2,600, and that was in full settlement of the debt. The fridge freezer had cost 5,000. So we have this, this, and this. So the 5,000 is going to be coming out of our equipment account, or that row. If the net book value is 2,600, then depreciation is equal to 2,400. Remember, whenever we dispose of an asset, we have to get rid of all the depreciation associated with it. And then a creditor will be reduced by 2,700. So once you know how to do this process, it's actually not too tricky. So what do we have? 5,000 to 7. So 5,000 less 5,000 less 2,7 down in creditors. 2,7. So we're reducing our creditors. We no longer owe them money. Our depreciation of equipment was 2,400. So that will be going up. Yeah. So depreciation is a negative asset. So if we're reducing our depreciation charge, it's going to be going up. So that's 2,600. Less 2,600. So this has to be less 2,600. Where do we think that €100 is going to go? It's going to go into our P&L. So why is it going into our P&L? Well, if you look at our disposal account, we would have received in our bank, account 2,700. So this is our disposal account. Yeah, so that would be the double entry, 270. For example, actually, it's not coming from bank. I probably shouldn't use that. I should say creditors. I might just do all T accounts. So there's going to be a few. So we have loads involved. Disposal, we have creditors, we have our fixed asset of equipment, and we have depreciation of equipment. So, and then we have our EARL, EARL. So if we are reducing our creditors, so creditors is a liability. If we're reducing it, it's going to be on the debit side. So 2,700 going to disposal. So that's the double entry. Now we'll use a different color. For equipment, if we're getting rid of equipment that was worth 5,000 or that we bought for 5,000, or the value less depreciation was 5,000, then it would be reducing our asset, which would be a credit. So that's also going to disposal. So coming from equipment is 5,000. Depreciation of equipment. So the depreciation we said was 2,400. So generally the opening balance would be here. So if we're reducing the balance of our depreciation, again using a different color, it would go here. So that 2,400 going to, again, disposal. coming from depreciation is 2,400. So if we balance them off, we have 5,100, 5,100. The balance, if you can see that, is 100, and that's going to your P&L. So we always write, whenever we're doing disposals, we always write off whatever it is to P&L, either a loss on sale or a profit on sale. So if you double entry that into our P&L account, it's a revenue. So we're doubling entry that into P&L, so it's a revenue. So that is to help with your understanding. You don't have to do that. However, it should help, as I said, with your understanding. Now, what is next? So we're on to the last adjustment. Very good. The depreciation charge on buildings for the year is 2% of net book value. Okay, net book value. So that's important. The depreciation charge is to be calculated from date of revaluation or date of purchase as appropriate. The total depreciation charge on equipment was 9,200. So you can put that in straight away, 9,200 into depreciation. That's reducing our assets. So land and building might be a bit tricky. So we'll look at the December. So we revalue, so it's net book value. So net book value, that's cost minus depreciation. So how much it's actually worth. It's net value. Yeah. Now, since we revalued our buildings to our land and buildings to 450,000, we also got rid of depreciation. And because we got rid of depreciation, that means there's nothing left in the account. So it's actually 4,500 minus 0. So it's handy. It's still going to remain 4,500. So now, what else do we need to know? So we made a note of this in January. There's no depreciation on land. The land element was 120,000. So you have to take away the land. So the buildings element is 330,000. So 330,000 at 2%. And that's for the full year because we revalued on the 1st of the 1st. So that's perfect. However, we also bought buildings on the 1st of February. Yeah, so we bought an adjoining business, including building of 78,000. So you also have to account for 78,000 at 2%. Now we have to be careful here because if we purchased on the 1st of February and our policy is to, what was our policy? Depreciation charges to be calculated on the date of purchase. So that means that we only want to, don't know why I put the equal sign there, we only want 11 of the 12 months. Because we're not including January because we didn't own it in January. So why would we? Like, its value on the 1st of February already took into account its depreciation, so we wouldn't depreciate for another month. So if you put that into your calculator, you get 1,430 and 6,600. So if we add those two together, 8,030, 8030. So depreciation of land and buildings, 8030. So that is 17,000. Okay, 17,000 to 30. So where do we send our depreciation charge? It always goes into P&L. Now, if we wanted to, we could have put those two depreciations together. So when we did our bank in May, but I just think that it would have maybe caused a lot of problems because I like to go straight on to December after that. So with that, we can now finish the rest of this, I believe. So our land and buildings, the value of our land and buildings is now 520,000. Our depreciation is now 8030. Our equipment is worth 177,000. 54,600 is depreciation for equipment. 56,950 is our stock. I don't know why I did that. 56,950. Debtors 113,000. Provision for bad debt 5,130. Bank 15,650 as a negative value. And goodwill remains 6,000. And so that is 790. Okay, down here, share capital 550,000, premium 110,000, creditors 48,700, VAT 3,793, P&L 10,027. 10,027. Revaluation reserve 75,000. And if we add all that together, we will get the same 798,790. So that 100% balances. It's not an easy question, these tabular statements. Like, even from the beginning, you're under pressure in terms of remembering your bank should be a negative asset, realizing that depreciation has to be in your table, and realizing that provision for bad debt. So just from the onset, it's quite tricky. And then I guess the hardest adjustments are these bank statements when we have expenses or gains prepaid or due. Or goods with tax aren't the easiest, but they are doable. Remembering to do the goodwill with the February one when we purchase a building, and remembering the land element isn't depreciated. What else do we have? When we're doing the provision for bad debt, remember it's only the increase goes into the P&L and the increase goes into the table. And here we'll either have, it's like a disposal you do if you're doing a depreciation question. So sometimes doing the T accounts for that might give you a hand. So thank you very much for watching. I hope it helped you in your understanding of tabular statement questions. Thanks for watching.